Welcome to the Investors Trading Academy talking glossary of financial terms and events. Our word of the day is recession. A recession is technically defined as 2 consecutive quarters of shrinking output, or a country going backwards financially. The eurozone is currently teetering on the edge of recession, triggered in part by the crisis, which has rolled on since May 2010. A double-dip recession is when a country has been in recession enters a downturn again after a brief and weak recovery. A more technical explanation is when a significant decline in activity across the economy lasts longer than a few months. It is visible in industrial production, employment, real income, and wholesale retail trade. The technical indicator of a recession is 2 consecutive quarters of negative economic growth as measured by a country's gross domestic product. A recession is a normal part of the business cycle. However, one-time crisis events can often trigger the onset of a recession. The global recession of 2008-9 brought a great amount of attention to the risky investment strategies used by many large financial institutions, along with the truly global nature of the financial system. As a result of such a widespread global recession, the economies of virtually all the world's developed and developing nations suffered extreme setbacks, and numerous government policies were implemented to help prevent a similar future financial crisis. A recession generally lasts from 6 to 18 months, and interest rates usually fall in during these months to stimulate the economy by offering cheap rates at which to borrow money. The International Monetary Fund, IMF, uses a broad set of criteria to identify recessions, including a decrease in per capita gross domestic product. According to the IMF's definition, this drop in domestic output must coincide with a weakening of other macroeconomic indicators, such as trade, capital flows, and employment.